Hey everyone, and welcome back. We always like to take a deep dive into investment ideas, and today we're looking at some ultra-high yield dividend stocks.
Ultra high yield. That sounds promising.
Yeah, especially if you're looking for some ways to boost your income stream in your portfolio. We found this Motley Fool article that had some pretty interesting recommendations.
Okay, great. So what kind of companies are we talking about here?
So the first one that really caught my eye is Enterprise Products Partners.
Okay, EPD.
That's the one, ticker symbol EPD.
Yeah.
And right off the bat, they've got a 6.79% yield.
Wow, almost 7%.
I know.
Yeah.
Pretty impressive, right? And on top of that, they've increased their distributions for, get this, 26 years in a row.
26 years. That's incredible. What's their secret? What are they doing?
Well, to be honest, I was curious about that myself. So I did a little digging, and it turns out they're a midstream energy company.
Midstream. So they're not drilling for oil or refining it.
Exactly. They're kind of like the middlemen. They own and operate the pipelines and storage facilities that transport oil and gas.
Okay, so they're the ones moving the energy around.
You got it. They're the crucial link between the producers and the consumers.
I see. And they must be doing pretty well if they can afford that kind of dividend yield and those consistent increases for so long.
They are. And it's not a small operation either. We're talking over 50,000 miles of pipelines.
50,000? Wow. That's a lot of pipelines.
Yeah, it really is. It's like wrapping around the earth twice.
Yeah.
They're a pretty big player in the energy sector.
So with all those assets and that kind of scale, they must be a pretty safe investment, right?
That's what I was thinking. And it seems like the credit rating agencies agree with us. They're the only midstream company with an A rating.
An A rating. That's pretty rare, especially in the energy sector. What does that mean for investors?
Well, basically, it means that they're seen as a very reliable and stable company. They're likely to keep those distributions coming year after year.
Okay, so that's good news for income investors who are looking for that kind of security and consistency.
Exactly. But the article also mentions this thing called ROIC, Return on Invested Capital.
ROIC, I've heard of that. But can you explain it in simple terms?
Sure. So ROIC is basically a measure of how well a company uses its money to generate profits. Think of it like this. If you invest $100 and you get $10 back in profit, that's a 10% ROIC.
Okay, that makes sense. So the higher the ROIC, the better the company is at using its money to make more money.
Exactly. And guess what? Enterprise Products Partners has been consistently achieving double-digit ROIC for over 2 decades.
Wow, so they're not just making money, they're making money efficiently.
That's what it looks like. And that's a good sign for investors because it means they're likely to continue growing and paying out those dividends.
Absolutely. So we've got a company with a huge network of pipelines, a solid track record of dividend payments, and a history of strong financial performance. Anything else we should know about Enterprise Products Partners?
Well, the article does mention that there might be some potential benefits from incoming Trump administration policies. But, we try to stay neutral here. So we're not going to get into the political stuff too much.
Of course. We just want to give our listeners the information they need to make their own decisions.
Right. So just to be clear, we're not endorsing any political stance here. We're just reporting on what the article says.
Got it. So what are these potential benefits that the article mentions?
Well, they don't get into specifics, but they suggest that policies that encourage domestic energy production could lead to increased demand for enterprises' pipeline services.
That makes sense. If there's more oil and gas being produced domestically, then they'll need more pipelines to transport it.
Exactly. And that could potentially boost their profits and those dividends we're all looking for.
Okay, so it's something to keep an eye on, but we can't predict the future.
Definitely not. Now, one last thing about Enterprise Products Partners. The article mentions that they have a PE ratio of 10.5x forward earnings.
Okay, so for those who aren't familiar with PE ratios, can you break that down for us?
Sure. The PE ratio basically tells you how much you're paying for every dollar of a company's expected future earnings.
Okay, so a higher PE ratio means you're paying more for each dollar of earnings.
Right. So in this case, a 10.5x PE suggests that Enterprise Products Partners is trading at a reasonable price relative to their anticipated earnings. It's not a screaming bargain, but it's not overpriced either.
So it's somewhere in the middle.
Yeah, I'd say so. So overall, Enterprise Products Partners seems like a pretty solid company with a track record of stability, a good dividend, and potential for growth.
Okay, interesting. Now, I know the article also mentions another company that caught your attention, Pfizer, right?
Yeah, PFE. But before we jump into that one, I got to admit, when I think of big pharma, I don't always get the warmest fuzzies. you know?
Yeah, I get it. The article even makes a comparison to the Grinch.
Exactly. But before we dismiss them completely, let's take a look at why Pfizer might actually be a good pick for income investors.
All right, let's hear it. What makes them stand out?
Well, first of all, they've got a pretty attractive dividend yield, currently sitting at 6.53%.
Okay, not bad. Almost as high as enterprise products partners.
Yeah, and there's potential for that dividend to grow in the future.
That's always a good sign. What else is working in Pfizer's favor?
Well, they've got a few newer products that are driving growth. One example is their Abrisvo vaccine for RSV.
RSV, what's that stand for again?
Respiratory syncytial virus. It's a pretty common respiratory illness, especially in young children and older adults.
Oh, okay, I've heard of that. So this vaccine is a big deal for them.
It could be. And it's not just new products. They've also been making some smart acquisitions lately.
Acquisitions, meaning they're buying other companies.
Exactly. And those acquisitions are starting to pay off. Drugs like Etcetras and Padchev, which they got through acquisitions, are now contributing significantly to their revenue.
So they're growing both organically and through acquisitions. It's a good strategy.
Yeah, it seems to be working for them. But, it's not all sunshine and rainbows with Pfizer. They're facing some challenges too.
What kind of challenges?
Well, for one thing, they're dealing with declining revenue from their COVID-19 treatments.
That makes sense. The pandemic is winding down, so the demand for those treatments is going to decrease.
Exactly. And on top of that, they're also facing some potential patent expirations.
Patent expirations. Why is that a big deal for pharmaceutical companies?
Well, when a drug loses its patent protection,
Yeah?
it means that other companies can start making generic versions of it.
And generic drugs are usually a lot cheaper, right?
Exactly. So when a company like Pfizer loses patent protection on a major drug, their sales can take a big hit.
I see. So that's definitely something to watch out for.
Yeah. And to make matters even more complex, the article also mentions some concerns about the potential impact of a second Trump term on Pfizer.
Politics. It always seems to find its way into the conversation.
It does. But again, we're not taking sides here. We're just reporting on what the article says.
Okay, fair enough.
Yeah.
So what are these concerns about a second Trump term?
Well, they don't go into a lot of detail, but they suggest that there might be changes to drug pricing regulations or healthcare policy shifts that could hurt Pfizer's bottom line.
Okay, so there's some uncertainty there.
Definitely.
Yeah.
We'll have to wait and see what happens. But it's something to keep in mind.
Absolutely. Now, you mentioned that Pfizer's PE ratio is below 8.7x. What does that tell us about their valuation compared to enterprise products partners?
Well, remember, the PE ratio is the price you pay for every dollar of earnings. So a lower PE ratio generally means that the stock is considered to be more undervalued.
So even though both companies have attractive dividend yields, the market seems to be pressing in more risk or uncertainty with Pfizer.
It seems that way. Maybe it's because of those patent expirations or the potential political headwinds we talked about.
It's probably a combination of factors, but it's interesting to see how the market is valuing these two companies differently.
Yeah, it really highlights the importance of looking beyond just the dividend yield and considering the bigger picture.
Agreed. Now, speaking of different companies, let's move on to the third one that the article highlights, United Parcel Service.
UPS, the delivery giants.
I feel like everyone knows UPS, especially around the holidays.
Yeah, it's hard to imagine December without seeing those brown trucks everywhere.
True, but the article describes their recent stock performance as a lump of coal.
Yeah, not exactly the festive image we're used to. So what's going on with the UPS? Why the rough patch?
Well, they've been facing some headwinds lately, but there are definitely signs of a turnaround.
Like what?
Well, in the third quarter of 2024, they reported both revenue and profit growth, and they also finally settled those costly contract negotiations with the Teamsters Union.
Oh, yeah, those were dragging on for a while.
They were. So that settlement is good news for UPS. It takes a lot of uncertainty off the table.
So it sounds like they're starting to get back on track. What are they doing to turn things around and get back on the path to growth?
One of their key focuses is improving profitability.
Makes sense. How are they doing that?
Well, they're streamlining their operations, optimizing delivery routes, and getting more efficient.
So they're finding ways to do more with less.
Exactly. And they're also strategically expanding into new markets.
New markets. Tell me more about that.
Well, they're making a big push into healthcare logistics, which is a growing market with a lot of potential.
That makes sense with the aging population and the increasing demand for medical supplies.
And they're also expanding their services for small and medium-sized businesses.
Okay, so they're diversifying their offerings and positioning themselves for long-term growth.
That's the idea. Now let's talk dividends. How does UPS's dividend stack up against Enterprise Products Partners and Pfizer?
Well, their current dividend yield is 5.19%.
Okay, still pretty good, but a little lower than the other two.
Yeah, but what's impressive is their consistency. They've increased their dividend for 15 years straight.
Wow, that's a solid track record. It shows a commitment to rewarding shareholders.
Exactly. So while the yield might be slightly lower, the reliability and potential for future growth are still there.
So we've got three very different companies, each with its own set of opportunities and challenges.
It's all about finding the right balance for your own investment goals and risk tolerance, right?
Absolutely, and that's what makes investing so fascinating. You know, it's really interesting. We've looked at these three companies, and they're all so different.
I know, right? It's like we've got a little bit of everything, energy pipelines, big pharma package delivery.
But they all have that one thing in common, that ultra-high dividend yield.
Exactly. And that's what makes them so appealing to income investors.
Especially in this market where it feels like everything is so volatile.
Yeah, it's nice to have some stability and predictability in your portfolio.
Absolutely. Now, this deep dive was inspired by that Motley Fool article we talked about.
Right. The one that recommended these stocks as potential stocking stuffers.
Exactly. But, you know, we always encourage our listeners to do their own research.
Oh, absolutely. Don't just take our word for it.
Right. Do your due diligence, read the financial statements, check out the analyst reports.
And maybe even talk to a financial advisor if you need some guidance.
Exactly. It's your money, so you want to make sure you're comfortable with the decisions you're making.
Now, speaking of decisions, let's put this back to our listeners.
Okay, good idea.
Let's say you're building an income-focused portfolio, and you had to choose just one of these stocks.
Tough choice.
It is. Which one would you go for, and why?
Would you go for the highest yield, even if it meant taking on more risk?
Or would you prioritize stability and a proven track record of dividend growth?
Lots to consider.
There is.
So let's think about each company for a second.
Okay, good idea.
Enterprise Products Partners, they're like that solid, dependable friend who always shows up on time and never lets you down.
I like that analogy. They've got that huge network of pipelines that credit rating and those consistent dividend increases.
Exactly. They're all about steady, reliable income.
Okay, what about Pfizer?
Pfizer is a bit more of a wild card. They've got that potential for growth driven by new products and acquisitions.
Right, but they're also facing those patent expirations and potential political headwinds.
So it's a bit more of a high-risk, high-reward situation.
I see. And then there's UPS.
Yeah, they're kind of like the comeback kid. They've had some struggles, but they're showing signs of a turnaround. Right, they're focusing on profitability and expanding into new markets.
So there's potential for growth there, but it's not a sure thing.
It's like choosing which holiday dessert to indulge in.
Ooh, I like that analogy.
Are you craving the familiar comfort of a classic chocolate cake?
Or are you feeling adventurous and want to try something new and exciting?
There's no right or wrong answer.
Exactly. It all depends on your personal preferences and your risk tolerance.
Speaking of exploring, we've got some links in the show notes for our listeners.
Oh yeah, good point.
You can check out the financial statements, read some analyst reports, and really dig into these companies.
Don't forget, knowledge is power.
And remember, investing is a marathon, not a sprint.
True that.
It's about staying informed, staying engaged, and never stop learning.
So before we wrap up this part of our deep dive, I want to leave our listeners with one final thought.
Okay, what's that?
We focused on these three companies today, but it's important to think about how they fit into a broader portfolio strategy.
That's a great point. You don't want to put all your eggs in one basket.
Exactly.
Yeah.
You need diversification to manage your risk and achieve your long-term financial goals.
It's like building a delicious and well-balanced meal.
I like where you're going with this.
You wouldn't want a plate full of just desserts, no matter how tempting they might be.
So true.
Mm-hmm.
You need a mix of different ingredients to stay healthy and energized.
And the same goes for your portfolio.
So as you continue on your investing journey, think about how you can create a portfolio that aligns with your goals, your risk tolerance, and your long-term vision.
It's a question worth pondering.
Okay, so we're back.
Yeah.
And we've been talking about these, ultra-high yield dividend stocks.
Like those little bonus gifts you find in your stocking.
Yeah, exactly. The stocking stuffers for your portfolio.
We've got Enterprise Products Partners, those pipeline people with their steady distributions and that A rating.
Yeah, and then Pfizer, they're kind of a wild card with their new drugs and acquisitions, but they've got those patent expirations looming.
And of course, we can't forget about good old UPS. They're working on that comeback story, trying to get back on track and expand into those new markets.
You know what's great about this deep dive, though? We didn't just scratch the surface.
Oh, definitely not. We really got into the nitty-gritty of how these companies work.
Their strengths, their weaknesses,
Yeah.
what they're doing to navigate the current market and the political landscape.
All as important factors that can affect their performance and ultimately your investment.
Because at the end of the day, it's all about making informed decisions, right?
Absolutely. It's like putting a puzzle together.
Yeah. Each piece of information helps us see the bigger picture more clearly.
And helps you make a smarter choice.
Exactly. So now that we've given you all the pieces, it's time to put your chef's hat on.
That's right. It's your turn to create something amazing.
So here's the challenge.
Yeah.
If you had to pick just one of these stocks for your income-focused portfolio, which one would you choose? And why?
Would you go for that reliable, steady Eddy Enterprise Products Partners?
The one that's been consistently paying out those dividends year after year.
Or would you be more drawn to Pfizer and that potential for growth?
Even with the risks of those patent expirations and the political uncertainties.
Or maybe you'd be a believer in UPS and their comeback story.
They're putting in the work to improve profitability, and they're making those strategic moves to diversify.
That's a tough choice, I know.
It really is. There's no right or wrong answer here.
It all comes down to your own personal circumstances, your risk tolerance, and what you're hoping to achieve with your investments.
And that's what makes investing so personal and so interesting.
It's a journey.
It really is. A journey of learning and discovery.
And don't be afraid to ask for help along the way.
Yeah. If you're feeling lost or overwhelmed, talk to a financial advisor.
They can help you create a plan that works for you.
Exactly.
Yeah.
So before we wrap up this deep dive, I want to leave you with one last thought.
Okay, what's that?
We've talked a lot about dividends today.
Yeah, those lovely streams of income.
But it's important to remember that dividends are just one piece of the puzzle.
It's true.
Don't forget about diversification.
Ah, yes. The key to a healthy and balanced portfolio.
Exactly. You want to spread your risk across different asset classes.
Like bonds and real estate, maybe even some alternative investments.
It's all about finding that perfect mix of ingredients to meet your financial goals.
So as you continue on your investing journey, keep learning, keep exploring, and most importantly, have fun.
Because at the end of the day, investing should be exciting. It's about building a brighter future for yourself.
And who doesn't want that?
Well said. Well, that's it for our deep dive into ultra-high yield dividend stocks.
Thanks for joining us.
And we'll catch you on the next one.